Welcome to Taking Stock for the week ending the 21st of August 2026. My name's Matthew Swartz. I'm the Senior Portfolio Manager of our managed funds. And joining me today is our Senior Equities Analyst, Jason Yin. It's obviously been a very busy week, Jason, financial reports. So thanks for taking the time to join us today.
Always a pleasure to be on, Matthew.
Now, before we begin, a reminder that today's discussion is general in nature and does not consider your personal circumstances. Nothing we discuss should be taken as financial advice or as a recommendation to buy, hold, or sell any security. Now, that's out the way. Jace, reporting season has been absolutely manic, but hanging over everything this week has been Iran, oil, and of course, President Donald Trump.
Yeah, Matthew, it's been one of those weeks where you can spend all day buried in company results and then look up and realize that the macro picture has shifted again. No surprises there. Tensions around Iran and also the Strait of Hormuz remains elevated, and that uncertainty has definitely pushed oil prices higher again. And from an investor's perspective, the key issue here is duration. Markets generally absorb a short geopolitical shock quite easily, but it becomes a little bit problematic if higher oil starts feeding into inflation, transportation costs, consumer spending, and ultimately interest rate expectations.
Yeah, that's right, Jason. We're already getting hints of that through company commentary. Higher fuel prices don't just affect energy companies. They flow through freight, retailers, and household budgets, and that's particularly relevant when consumers are already being selective about what they spend. Which brings us to the retailers. JB Hi-Fi, Super Retail, and Universal Store all reported this week, and there were some quite different messages. JB Hi-Fi delivered another very strong year with record group sales of 11.1 billion and NPAT of around 490 million. Yet the shares fell as investors focused on softer trading update in July.
Yeah, and I think that really captures how reporting season works. The market already knew that FY26 was going to be a strong year, but what investors cared about was the new information that was coming out, and that was a softer start to FY27. We'll circle back on this in regards to our question of the week later on in this episode, Matthew.
Yeah, and Super Retail gave us another interesting read. Sales grew, but profit declined, with BCF and Macpac having yet another tough year. Management also pointed to poor weather, higher fuel prices, and cost of living pressures. And you can understand the connection. If filling up the car suddenly costs a lot more, discretionary activities like camping, boating, or simply taking a long weekend drive become that little bit more expensive.
Yeah, absolutely, Matthew. But Universal Store reminds us that we shouldn't really generalize too much about the consumer. If you look at the business's younger customer profile, they've continued to spend relatively well, and Universal Store and also Perfect Stranger both performed rather strongly as well. The only weakness that I saw was from their Thrills brand, and this was particular to its wholesale channel. But nonetheless, the consumer isn't simply classified as either weak or strong, Matthew. Brand strength, demographics, and also having the right product still really matter enormously for retailers.
And shifting gears here from the consumer to healthcare, and their results were probably even more interesting.
Mm.
CSL, Cochlear, and Pro Medicus all reported, and you could almost use the three companies as a case study in different stages of the investment cycle. CSL is trying to restore confidence. Cochlear is working through a downgrade, while Pro Medicus continues to deliver exceptional growth. Now let's start with CSL. The headline statutory numbers were quite ugly. The company
Mm.
reported a very large loss after billions of dollars of impairment and restructuring charges. Yet the shares rallied in. They rallied quite hard, didn't they, Jace?
They certainly did. And the reason is that investors, again, already knew that FY26 was going to be a very ugly year and also a year of resets as well. But what mattered more was that the core bearings business showed signs of stabilizing. Immunoglobulin momentum improved in the second half. Channel inventories looked a lot healthier than where they were in first half 26. And management is guiding to modest underlying earnings growth in FY27, which has been very positively received.
So no, it's not fixed, but perhaps less broken than investors had initially feared. There are
Mm.
still issues. Vifor remains under pressure. Gross margin recovery will take its time, and clearly the acquisition of Vifor has been a poor allocation of capital outcome. But after such a significant derating, the market was really looking for evidence that the core CSL franchise bearing remains intact.
Exactly, and this result gave investors some of that, Matthew. Cochlear is a little bit different. FY26 earnings were weak, margins came under a bit of pressure, and also hospital capacity remains an issue in some of the markets, particularly in North America. There were some encouraging signs in the second half, though, particularly around the adoption of the Nexa implant, which is its new generation device. And I'll still describe this as more of a stabilizing result than a full recovery story.
And then finally, at the other end of the spectrum, we've got Pro Medicus. Revenue growth remained very, very strong. Margins are extraordinary. It keeps signing major contracts and customer retention remains excellent. With Pro Medicus, the debate really isn't whether this is a high quality business, is it, Jace?
Yeah, that's right. We've had a lot of debate about what it means to be a high quality business this week, Matthew, and it's, I think, primarily centered around how much you actually pay for that quality. And that's the difficult part because when companies execute this consistently, like Promedicus, investors naturally gravitate towards paying a little bit more for increasingly large premiums for that level of certainty.
So let's move on to SKS Technologies, Codan and Brambles. SKS delivered another very strong year with revenue up more than 30% and profit nearly doubling. Data center infrastructure remains the obvious driver. But the interesting debate at the moment is whether all of this spending on AI infrastructure can continue at the current pace.
Yeah, it's definitely very topical. And one thing that we think investors can sometimes overlook is that that capital isn't necessarily the only constraint. Increasingly, we are seeing a lot of shortage in terms of skilled labor, and data centers need electricians, technicians, engineers, and also project managers as well. And you can't just download these labor capital from the cloud. So that potentially gives experienced contractors like SKS a bit of an advantage. The valuation no longer looks cheap, so execution remains very important, but the medium-term funnel of work still looks rather solid.
Yeah, look, I interpreted that as a really strong result, Jace. And Codan also, yet again, delivered yet another exceptional year of growth. It is two particularly interesting businesses underneath it. Minelab is benefiting from the elevated gold price and demand for metal detectors, while communications continues to benefit from defense spending on software-defined radios and unmanned systems.
Yeah, and again, the earnings growth has been exceptional here. The challenge is that as the share price rises, expectations will also naturally rise with it as well. So from here, the company still has to really continue to deliver the earnings.
And Brambles was perhaps the opposite story. The underlying business does remain strong, but there has been very specific operational problem in its US pallet repair network. More automated warehouses mean pallets need to meet tighter quality standards, which increases repair requirements. And at the same time, Brambles has dealt with subcontractor turnover and labor shortages.
Yeah, and certainly has. And that really means that demand for the product isn't really the problem. The key issue that we identified in the May downgrade was that Brambles can somewhat normalize its US repair network without permanently lifting its cost base. It seems like it's doing that, but there has been some ramifications that we did see in the second half. Now, this also looks like it's going to be a little bit of an execution issue as well, and any deterioration in the underlying quality or also the competitive position of this business will really change the thesis from investors.
Let's put BHP under the microscope this week because one statistic from the result really did stand out to us. For the first time, copper has overtaken iron ore as BHP's largest earning contributor. That feels quite significant when you consider the generations of Australian investors have effectively viewed BHP as an iron ore company.
Yeah, it's definitely a significant milestone, Matthew, and it does tell us the direction the portfolio is heading. The company believes the world is going to need substantially more copper for electricity grids, renewable energy, and also electric vehicles, as well as the increasing data center and also AI infrastructure that we are seeing around as well. Iron ore still remains a pretty standout cash generating business, but increasingly those cash flows can help finance BHP's growth into its copper.
That can, and it's almost using yesterday's cash cow to build tomorrow's growth engine. And there's an interesting connection back to the AI theme we just discussed with SKS. AI might live in the cloud, but the cloud itself needs an enormous amount of physical infrastructure.
Exactly. And it all comes back down to power generation, transmission networks, transformers, wiring. all of that requires copper. And the risk is that copper prices are already strong and plenty of optimism is reflected in this thematic right now. But BHP's changing earnings mix is something investors should be paying close attention to over the next decade.
All right, Jace, it's question of the week time, and obviously quite topical during reporting period. So, why can a company report record profits and its share price falls while another reports a massive statutory loss and its share price rises? Because that's effectively been the case for JB Hi-Fi and CSL this week.
Exactly, Matthew. And I think this is one of the very important lessons from reporting season. The market doesn't reward whether a result is objectively good or bad. It does, however, reward result that is better or worse than what investors were already expecting. Now, JB Hi-Fi reported record sales and also profits, but the market already knew that FY26 was going to be a strong year. The new information takeaway was that there was a pretty soft July trading period, so the shares fell on that announcement. In CSL's case, the company reported a relatively huge statutory loss, but investors already expected that, and the impairments that were going to flow through into this second half, making it a very difficult year. The new information takeaway was that bearings appears to be stabilizing and that FY27 should return to modest earnings growth. So the shares rallied as a result.
It's almost like every company is sitting an exam, but investors never get to see the marking guide. Consensus expectations, guidance, and the valuation effectively determine what score the company needs to achieve. A business can grow by 20%, but if investors were expecting 30%, that 20% can actually be very disappointing.
Yeah, and the vice versa is also true as well. When you think about a beaten up company, they can report declining earnings and still rally if the market was positioned for something a lot worse.
So rather than simply asking, was it a good result, investors should probably ask, was it a good result relative to the market's expectations?
Absolutely. And the next question is whether whatever surprised the market is temporary or was it structural? Now, that's usually far more important than what the headline number itself is suggesting.
Thank you so much for your thoughts today, Jason. We've covered a lot of ground today and hopefully given members a useful snapshot of what has been a very busy reporting period so far, as well as some of the bigger macro themes shaping markets.
Thanks, Matthew. It's always a pleasure to be on.
And thanks to everyone for listening. We'll be back next week to unpack the next round of results and the key issues moving markets. Until then, take care.